This is Matthew Cratter from Trader University, and today I want to answer the question, is Ethereum, is Ether a good investment? This is a question I've been getting a lot, and I will be discussing in this video whether it's a good long-term investment. I'm not going to talk about the case for trading it. Obviously, it has a great looking chart here, got close to hitting some new highs. And so if you want to trade it, that's one thing. The real question though, if you trade cryptocurrencies, will you be able to outperform Bitcoin? That's a question you have to ask yourself. Or will you be able to outperform basically just holding Bitcoin? We're going to talk about that a little bit in this video. One reason to take Ethereum seriously is because it currently has the second largest market cap of all the cryptocurrencies. Most of the cryptocurrencies are very, very small, almost negligible market caps. Bitcoin is about at 600 billion market cap. Ethereum at 141 billion. This large market cap tells us that we should take it seriously and not completely write it off. The other thing I like about Ethereum, the reason I'm interested in the project, is I'm fascinated by DeFi. I've done a couple videos on decentralized finance and these various protocols and how Ethereum gets locked up in them. I like the idea of a decentralized banking system that's not controlled by anyone. That being said, my feeling is that this is eventually going to be built on top of Bitcoin rather than on top of Ethereum. Obviously, Bitcoin doesn't offer the smart contract capability, but it does offer a much more simple and secure and elegant base layer, which we're going to be talking about. A lot of people noticed that Ethereum was hitting new highs, especially versus the US dollar. ETH USD exchange rate was hitting new highs or close to new highs a couple of days ago, and then had a bit of a reversal. This is if you look at it in terms of US dollars. What I encourage everyone to do, though, is also look at charts in terms of Bitcoin, denominated in Bitcoin as a unit of account. And if we do that, we can see that Bitcoin has been outperforming Ethereum for most of the time since 2018. If you look at this chart of Ethereum in Bitcoin terms, it's not nearly as impressive. We may be getting a breakout here. Perhaps Ethereum will outperform Bitcoin during the current bull market. It's very hard to tell. But if you want to bet on a trend continuing that has been in effect, that is that Ethereum will continue to depreciate in Bitcoin terms. This chart shows you if the price moves up, that's Ethereum strengthening against Bitcoin. If the chart moves down, if the price moves down, that's Bitcoin strengthening against Ethereum. Put in these terms, we can see that Ethereum has underperformed over the long term, really since the launch of Ethereum in 2017. Now, one of the things that really bugs me about Ethereum, and maybe this is just a stumbling block for me, I don't like the fact that there was a pre-mine. There were all these coins created. There was a 70% pre-mine at the beginning, and the founders and the foundation got a lot of this money. It's nice to be able to print up your own money, but it's not fair to later stakeholders. And something very different happened with Bitcoin, where there was no pre-mine. Satoshi himself had to mine his own coins. If I had a choice of investing with someone, that would always be with someone who has a lot of skin in the game, to use Nassim Taleb's term. Elon Musk, famous tweet, "If Tesla and SpaceX go bankrupt, so will I," as it should be. You contrast that with a message from Vitalik Buterin, who's the founder and creator of Ethereum. This is, I'm not sure the date on this. It looks like 2016. Vitalik says, I've sold about a quarter of my ETH. I'm not going to apologize for sound financial planning. Given the chance, you should always go with someone who never sells their stock and whose interests are aligned with yours. It's very different if you print up your own money and you exit and leave other people holding the bag. So that's one thing that's a big stumbling block for me, the idea. This is a problem for almost all cryptocurrencies except for Bitcoin. There's usually a huge pre-mine of the coins. In other words, they're mined before the coin launches, and insiders are given a lot of these pre-mined coins. This is very similar to the Cantillon Effect with fiat currencies, where those who are closest to the money printer benefit disproportionately over everyone else. Bitcoin is very different. In order to mine it, there was no pre-mine, and in order to mine it, you need to expend massive amounts of energy and buy very expensive equipment, or you just have to pay a very high price for Bitcoin. Bitcoin is like California or Manhattan real estate. It's always been expensive, and it keeps getting more expensive over long periods of time. So when I see a pre-mine, it's a huge red flag for me. It's one of the reasons I don't like XRP, and we've obviously seen the massive dumping by insiders in XRP. Always a warning sign. This is a message where Buterin said he received 550,000 Ethereum in the Genesis pre-mine, and then 150,000 in addition. I was unable to figure out exactly how many he still owns or still holds, but he's certainly Vitalik is certainly a billionaire on paper. I have no problem with people becoming billionaires. It's just a little weird when you print your own money and you become a billionaire before something has really launched or has really begun to serve a function in the real world. Ethereum does seem to have some traction, as evidenced by the high market cap. That being said, it's still a project that's very close to being a startup. It still has a lot more risk, in my opinion, associated with it than something like Bitcoin. If you're enjoying this video and finding it helpful, I would encourage you to hit that subscribe and like button right now. One way of measuring the security of a cryptocurrency, and obviously if you want to store your wealth in a currency, in a bank, in a protocol, you want to make sure that there is sufficient security. If you have a bunch of gold bars, you need something like Fort Knox. One way of measuring security for cryptocurrencies is to look at the hash rate, which is just the total computing power of the network. In this case, we can see that the Ethereum hash rate has only recently begun to surpass its 2018 highs. It really was dormant for a while. By contrast, Bitcoin's hash rate has been growing much more over time. And as a result, this is the Bitcoin network is a network where the security just gets better and better over time. If you're a company like MicroStrategy, if you're a billionaire like Michael Saylor, you want to store your wealth in something that cannot be hacked. And the higher the hash rate, the lower the chances of a 51% attack or something like that. If we look at the absolute hash rates of Ethereum, according to Masari here, the current hash rate of Ethereum is 326, I believe this is terahashes per second. By contrast, Bitcoin has a hash rate of 154,000 petahashes per second. If we do a comparison here, 326 terahashes, let's just make sure I got that right. Yeah. 326 terahashes converted to petahashes is just 0.326. So we can see here that Bitcoin has a hash rate of 154,000 petahashes versus 0.326 petahashes. The Bitcoin network is the most secure cryptocurrency network out there, and it's more secure as measured by hash rate by many orders of magnitude over Ethereum. This is probably one reason that Ethereum is in the process of moving from proof of work, which is how Bitcoin works. You have these Bitcoin miners that run the algorithm and try to find a solution and compete for a solution, and whoever solves the math problem gets awarded the miner subsidy, which is 6.25 new Bitcoin, and they get to add the block to the blockchain. Ethereum, the fees have been very high for many years, and you also have this problem where the hash rate is not nearly as high as Bitcoin. And so Ethereum has been in the process of transitioning from a proof of work consensus mechanism, how everyone on the network gets together and decides what a new block is, what transactions are included, which is the real blockchain. It's moving from proof of work, which is what Bitcoin uses, to proof of stake. If you want to dig a little deeper into this, I will link to my proof of work versus proof of stake video below. One problem with ETH is that you can still mine it using GPUs. So right now, there are basically two forms of Ethereum running. There's the original form, which is proof of work, and then they've started also doing Ethereum 2.0 for part of it, which is proof of stake. One problem with ETH under proof of work is that you could mine it with GPUs, which are very commonly available. Bitcoin, the hash rate has moved up so much and there's so much power in the network that you need these highly specialized machines called ASICs to mine Bitcoin. These are much more expensive, much more difficult to get. If you wanted to launch a 51% attack and attack the blockchain on ETH, you just need to buy a bunch of GPUs. Everyone has these in their computers. They're much cheaper, and you could do a 51% attack. It's much more difficult if you needed to get together the number of ASICs that would be possible for that would be needed for a 51% attack. So Bitcoin network much more secure than ETH. Under proof of work, under the proof of work consensus mechanism, a miner, a Bitcoin miner or Ethereum miner, can only work on one block at a time. And when there's a chain dispute, when you have these different blockchains, the longer chain wins. This is how Bitcoin works. There's also real cost to mining Bitcoin. In this way, it's very much like mining gold. It's very expensive to mine gold, and it's very energy intensive as well. So there's a real external, real world cost to mining Bitcoin. Whereas under a proof of stake consensus mechanism, a miner, or they're usually called validators in this case, they're the equivalent of miners. They validate the transactions and validate the blocks. Under proof of stake, a validator can work on multiple blocks and multiple chains at the same time and doesn't need to expend nearly as much electricity. A lot of people, including Vitalik Buterin, badmouth Bitcoin for being very energy intensive. This is one of the critiques of Bitcoin. I discuss this in multiple videos, but the ultimate answer to this is if you want a secure place to store your wealth, you need to expend a lot of energy on security. This is what Fort Knox does to guard the gold bars. Advanced civilizations use a lot of energy. The internet uses a ton of energy, uses something like 10% of global electricity. No one wants to shut down the internet because it uses energy. Using energy is actually a great thing. I enjoy the fact that we have a washing machine. We don't have to wash our clothes by hand. That's a whole separate discussion. You can Google my various YouTube videos on Bitcoin and energy consumption. Normally, the people who tell you Bitcoin uses too much energy, they have something to sell you. They basically are telling you that Bitcoin is bad for the environment. Instead, buy my pre-mined cryptocurrency. So this is one problem. You always have to look at people's incentives, including Vitalik Buterin's, of course. So this is one problem with proof of stake. I just don't think it's as secure. It's also very, very much like the existing fiat system, where if you have a lot of money, you can make more money. Whereas proof of work is a much more basic form of capitalism, where you actually have to do real work to generate wealth in the form of proof of work mining. So under proof of stake, basically you can deposit, I think you need to deposit 32 ETH, and then you can become a validator. With Ethereum being over $1,000 a coin now, you can see that you need at least, I call it $30,000-$40,000 to start doing this. You could also do it, I think they're validator pools that you'll be able to participate in. So one reason to become a validator and to buy some ETH and stake it is to earn interest. Currently, it looks like you can earn about 10% annualized as a validator doing proof of stake with Ethereum. Now that sounds like a great interest rate. It is a great interest rate, and especially compared to where savings accounts are, less than 1% right now in the U.S. and negative in many places in Europe and Asia. But there's something called a yield hog. A yield hog is someone who invests in a high yield, perhaps a high yielding bond or a high yielding dividend stock, and gets very greedy for collecting that yield, but doesn't pay attention to the fact that he or she is going to lose on the underlying investment. So you can buy a very high yielding dividend stock that has a dividend yield of something like 20%. What this means is that the market is pricing in a dividend cut. You're not going to make 20% a year on it. What's actually going to happen is there's going to be a dividend cut and you're going to lose money on the underlying stock. Maybe you'll make 10% of that on collecting dividends before the stock falls down, but then the stock will probably fall 30 or 40% and you'll end up with a net loss. So these high yields do work well as long as the currency stays steady or appreciates. Obviously, Ether has been appreciating quite nicely for the past 12 months. And so the real money has been made holding it. But this only works, again, if the underlying currency is a good store of value. And the great example of this is we could look at the Argentine peso, where interest rates are very high. You can earn, as far as I can tell, you can earn 30 or 40% in a savings account in Argentina on an annualized basis. This is great. Who doesn't want to earn 30% interest? The problem is that the currency is losing purchasing power by more than 30 or 40% every year. So there's a net loss. And this is one problem with proof of stake. You first have to get people to trust the underlying currency and that it won't be debased, that there won't be a huge new supply of Ether coming online sometime in the future, which will drive down the price of the underlying asset on which you're earning this yield. If a similar example here I pulled up from Nexo is you can still earn 6% APY on your XRP if you deposit it there. But again, this is a very bad investment because the underlying keeps going down, as has been the case with XRP. Another big problem that I have with Ethereum as a long-term investment is that it's not as decentralized as people believe. It uses, for its hosting, for its infrastructure, it uses companies like Infura, which is an actual corporation, as well as Amazon Web Services. And when one of these services goes down, what happens is the price feeds of Ether crash, and exchanges have to suspend the trading both of Ether and of coins, ERC20 tokens, which are cryptocurrencies and tokens that are built on top of Ether. So this is a real centralization problem that's not present with Bitcoin. So Infura, Amazon Web Services, this just happened recently in November 12th of 2020, where there was basically an outage. An outage occurred at Infura, and it affected the pricing and trading of Ethereum and ERC20 tokens. This article is from September 2019. I wasn't able to find an updated statistic, but as of then, 60% of Ethereum nodes run on Amazon Web Services. What happens if the US government tells Amazon Web Services to block Ethereum? Ethereum is used as the structural foundation for many stablecoins. If the US decides to regulate this area or to regulate these tokens, they could just send a strong message to Amazon Web Services to turn off or block Ethereum, and this would be a major devastating blow to Ethereum. As I said, I like the whole DeFi experiment. I think it's cool. I really hate centralized banks and the current financial system. But one problem I have with DeFi is you're building it on top of a proof of stake based foundation. So building it on Ethereum when Ethereum has these centralization problems and has these basically centralization problems in terms of the infrastructure and the ownership. Ethereum development is obviously highly driven by one individual, which is Vitalik Buterin. And if something were to happen to him, so a couple of years ago, people believed that he had been hit by a car or something, and Ethereum immediately plummeted. It's very different with Bitcoin. Satoshi Nakamoto, hasn't been seen for many, many years. We still don't know who he is. He may be dead. He's never moved or sold his coins, etc. So it's very difficult when you have an immaculate conception, as Bitcoin had, where the founder bows out very early on, and as compared to something like Ethereum, where you have Buterin, who's always in the spotlight. He's a bit of a celebrity, and he can pretend that things are decentralized and developers are doing their own things, but he really is at the helm, and he's making these decisions. He's making the decision to move from proof of work to proof of stake. He's making the decision what the future monetary policy of Ethereum will be. And so to pretend that he's not there, I find just to be intellectually dishonest. So I want to conclude with this. What is the future monetary policy of ETH? It's been changed many times. Unlike Bitcoin, this transition from proof of work to proof of stake and paying validators is just the latest iteration. Whereas with Bitcoin, the code is still the way it was. We have these halvings every 4 years. The supply of new Bitcoin gets cut in half every 4 years. Staking, DeFi, they're very nice ways to tie up the supply of ETH. It's good to tie up the supply of a cryptocurrency like Bitcoin or Ethereum. When you limit the supply and you keep demand constant or increase demand, you obviously get an appreciation of price, which is good for the ecosystem. The problem is that staking, proof of stake, and DeFi only work as long as Ether and the DeFi tokens keep going up in price. If you get a very deep bear market, either for Ethereum or DeFi, people will be much more reluctant to tie up their value, their wealth, in either as a validator doing proof of stake or in these various tokens. So paying someone interest on their stake is not good enough unless the underlying asset is a good store of value, by which I mean it retains its purchasing power or goes up in time, as both gold and Bitcoin have done. There's a new part of the code that's about to be introduced that's actually going to destroy some of the Ethereum in some of the supply, which is a good thing. This is deflationary for the currency, which means that there are fewer ether circulating, and so something analogous to people putting their Bitcoin in cold storage, except in this case, the ETH is actually these fees that are paid in ETH to the validators end up being burned or destroyed. And so this obviously contracts the ETH supply, which is a good thing. But what offsets that is that validators will also receive freshly minted new ETH in exchange for validating transactions. So you have EIP 1559, which will decrease the supply of ETH. You have the validators' rewards, which will, for their staking, which will increase the supply of ETH. Does ETH supply increase or decrease over time? Historically, it's increased over time, but who really knows? I would guess that, like most currencies, the max supply is not capped as it is with Bitcoin, that it keeps going up over time. Maybe it goes up at a very low rate. They fix it at 1% or so. But we don't know. We simply don't know what the future monetary supply will be. We do know what it is going to be for Bitcoin. The problem with ETH is it's a very complicated project, and these things have been moving targets. They've been changing many times over time. And so it's impossible to have a high level of comfort that they're not going to change again. So I like ETH as an experimental project. It's interesting to watch. If you buy Ether, it's like investing in a startup. I think the chance of ETH going way, way down is much, much higher than the chance of Bitcoin going down. I would say the chance of Bitcoin going to zero is more like 1% or even less than that, or going close to zero. The probability of ETH going to zero, I would say, is much, much higher, 10, 20%. That's just my subjective assessment of the probabilities. But we can see that ETH is much more complicated. It's an evolving project. It's a live project. The founder is still around. And it's also a very complicated project with lots of moving parts. And the more moving parts you have, the more complicated things you're trying to do, the more room there is for various attacks on the currency, either hacking the code, looking for loopholes, doing 51% attacks, etc. The nice thing about Bitcoin is it really is finished. They tweak the underlying core software over time, very small tweaks, but the base layer is basically finished. We know the future monetary policy. We know how it works. There's a very large bug bounty associated with Bitcoin, where if you can somehow hack one of these public addresses that has $1 billion in it, you do very well. You can afford to spend $900 million paying the best hackers in the world and still walk away with $100 million. The money is just sitting out there and no one's been able to steal it yet, which shows you how secure Bitcoin is. A lot of this has to do with a very high hash rate, which also discourages 51% attacks. The other thing I would say is that store of value. If you think of Bitcoin as digital gold as a place to store wealth, this is a much bigger use case than the various use cases that have been proposed for Ethereum. Ethereum is always changing this over time, which is another disturbing thing. I guess it's okay because that's what startups do. They pivot. It was originally marketed as a world computer. Then it was marketed as a place to launch your crappy ICOs back in initial coin offerings back in 2017. And now there's the whole DeFi use case, which may or may not work. It's very cool, but it's not nearly as big of a category as store of value. If you think about store of value, it's a place to store all of your wealth, all of the world's wealth at the present time, as well as future wealth that will be generated. So I'm confident in 50 years from now, when some scientist figures out a way to do space travel better, maybe something like SpaceX, or figures out a cure for some chronic disease, the wealth that they earn from that, a part of it will be stored in Bitcoin. Bitcoin is stealing market share from traditional stores of value like gold and real estate. So the question I have, the problem I come up against, and again, I find the whole DeFi experiment fascinating. I don't like the fact that it's built on a foundation of sand, which is what I think proof of stake is. Do I really want to sell some of my Bitcoin to buy some ETH? I could allocate new cash to ETH, but then I have the same dilemma. Do I allocate that new cash instead to Bitcoin, about which I have a much higher comfort level and a much better understanding? And I think Bitcoin has a much better risk reward. Ethereum can go up a lot more than Bitcoin, possibly, but also it has a higher probability of going to zero or close to zero, or somehow failing or being shut down. And so I think you have to factor that in to your expected value for Ethereum. The other question is, will ETH not only go up in US dollar terms? If I convert my US dollars into ETH, will I make money? If you had done this, you're making great money for the past 12 months or so, 18 months. But the real question is that investment going to outperform Bitcoin? And that's a little more iffy. Yes, ETH has outperformed Bitcoin really in 2020 and 2021. You can make the argument that it will always outperform Bitcoin during these crypto bull market periods. I'm not totally sure of that. I'm a little bit agnostic. If I had to trade this chart, I would bet on it staying range bound. So this is the real problem. You not only need your ETH to go up so you make money in US dollar terms, but you need it to outperform Bitcoin if you also like Bitcoin. So if I trade in and out of ETH and then try to move back into Bitcoin, after paying taxes, if I do it in a taxable account, or even if I do it in a tax-deferred account or a Roth IRA or something like that, will I still really outperform Bitcoin? Nice thing about Bitcoin is you can buy it and hold it forever. You never need to sell it. You can borrow against it, etc. It's very tax efficient, and I feel comfortable storing some of my wealth in a very secure network with a very high hash rate like Bitcoin. I don't feel the same way about Ethereum. That's why I currently don't own any. I probably should just have a small amount to be watching it. But I feel at this point that I much rather have that money in Bitcoin instead. If you look at the comments below, you'll see all these disparaging comments, I'm sure, which will emerge about how I'm just a Bitcoin maximalist. I'm a Bitcoin maxi is the term that's used. This is actually a term that was coined by Vitalik Buterin himself. And it's a way of shutting down an honest dialogue and just calling names. I was called a Bitcoin maxi by all the XRP people who have since been destroyed by their preference for holding XRP over Bitcoin. But what I always say in response to this charge is I am open to new projects. I just haven't found any that would make me excited about allocating large amounts of capital to. If you call someone a Bitcoin maximalist, in my mind, it's a little bit like calling someone an Amazon maximalist or a Tesla maximalist. The thing about investments, businesses that rely on network effects, where the more people who join the network, the more people who will want to join the network, the more powerful the network effects, these lead to winner take all or winner take most markets. Calling someone a Google maximalist maybe felt good, but Google did take 90% of, or whatever it is, of search. And this is what happens. It's not true in every arena of investing. But when you have these networks, whether it's Amazon or Google, or even the Tesla network of owners and charging stations, etc., you tend to have a winner take all. And so this is what we have been seeing, where Bitcoin's market cap is the largest market cap. It stayed this way for a very long period of time. So you can accuse CoinMarketCap and these various other websites of being Bitcoin maximalists just because Bitcoin does continue to have the largest market cap. One thing about this that a lot of people misunderstand is that as the price of Bitcoin goes up, as its market cap increases, it actually becomes a safer investment. It becomes more attractive to large institutional investors like pensions and endowments. And they need a certain amount of liquidity. They need a certain size market cap to invest. And Bitcoin has always been that place. Right now, we're not really seeing any money going into Ethereum from Wall Street. Most of it, I would say 95% of it, is just going into Bitcoin. So this is a space I'm going to keep watching. If I missed something, I'd appreciate hearing about it in the comments. If you found this video helpful, be sure to hit that subscribe and like button, and also hit that notification bell if you want to be notified when I publish my next video. Many of you probably know a lot more about Ethereum than I do, so I'd be I look forward to reading your critiques of this critique in the comments section below. Just don't call me a Bitcoin maxi and leave it at that. That's not the most intelligent way to have a back and forth discussion. Thanks a lot for watching, and I'll see you in the next video.